Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. My name is Lakshay. Welcome to Real Estate and Taxes. Today's topic, we're going to be focusing on, can a PREC hold real estate? For those of you who don't know, PREC stands for Personal Real Estate Corporation. So basically, if you are an individual agent who has been working and getting commission under your personal name, you can technically minimize your taxes by incorporating. And the incorporation for real estate agents is called PREC, Personal Real Estate Corporation. So without further ado, let's get started. All right, so what is the purpose of the PREC? The idea behind PREC is to basically save taxes. Lawyers, accountants, doctors, we have this opportunity to incorporate from the past, but realtors only recently got it in October of 2020. Now you can basically incorporate and pay lower taxes. What do I mean by lower taxes? In Canada, whenever you earn more income under your personal name, you pay higher taxes based on your tax rate. So for, the lowest tax bracket might be 20%. And as you increase and earn more, like hundreds of thousands of dollars of income, you pay more taxes. On 100,000, it's 37%. And then as you reach $200,000 mark, you're sitting technically in 50% tax bracket. Yes, you heard it right. If you're earning around $200,000 of income, 50% of it will go in taxes. So how can we avoid that? You can incorporate and basically use a tax deferral system of an incorporation to avoid paying that high of taxes in 1 year. So on corporation, on first $500,000 of income, the taxes is only 12.2% tax. You heard it right. First $500,000 of income, the tax rate is only 12.2%. So what are the 4 key objectives of actually incorporating? Number 1 is protecting your assets. Basically, when you incorporate, you only are running your business under your corporation, and anything that you get sued for, your personal assets gets protected. Someone, sues you for maybe they didn't like the services or any of that sort. If they were to sue you, anything that is under your PREC will be up for litigation. Your personal house, your car will not be dragged into the litigation simply because your PREC is independent entity and it operates standalone. Second objective of incorporating is actually capital gains exemption on sale of business. A lot of people are, in the business of, they're basically building their assets, they're building brand, they're building their image in their business. And at one point or the other, they might eventually end up selling their business. When you sell a business or any incorporation, the first $829,000 approximately is exempt of capital gains tax. You heard it right. If you have a practice or you have a business that you sell under corporation, your first $800,000 odd dollars worth of capital gains is actually protected and you don't pay taxes on it. So that's the second objective of incorporating. Number 3 is, if you want to involve your family within your business, this is a great way to kind of have some indirect ownership within the PREC towards your family members. So great way again to kind of another objective of PREC that you can achieve when you incorporate. Number 4, last but not the least, saving taxes. Like I mentioned, in Canada, as you make more money, you pay more taxes. But with corporation, first $500,000 of income, there's a flat fee, which is 12.2% taxes. And it's simply far better than if you were to earn the same amount under your personal name. Now that we understand what PREC is, let's understand what the structure for a PREC would look like. A PREC basically must be a provincial corporation because all of your licenses are actually tied to the province of Ontario. You must have equity shareholders just like any other corporation and preferred shareholders. Equity shareholders are voting shareholders, and RICO has specifically said that voting shareholders must be the sales agent, which means you must be the broker of the salesperson, you must be the controlling shareholder of the brokerage, and you must be the sole director or the president. So you cannot have family members under the voting shareholders part. But under the non-voting shareholders, you can have family members join in as an indirect, spouse, children can be given non-voting shareholders and become part of your PREC. So this is the overall structure that I wanted to highlight. So anyone who's looking to incorporate, actually someone reached out today as well to incorporate their real estate business. So I'm going to be opening their incorporation, and this is technically what the structure would look like for them as well. Now, because it's a tax season, I wanted to highlight what are some of the expenses and income that you can keep track of. This is a nice template that I use for my clients to kind of identify their various levels of expenses and classify them by month. This is a great tool, great strategy for someone who's, get organized, track their income and expenses. I can even share that with you after the presentation. So shoot me an email. But this is a great way to kind of keep an eye out as to what are some of the big buckets where you're spending your money. Advertising, commission rebates, which is basically, cash back, fuel costs, gifts and incentive, insurances, office supplies, RICO and TREP fees, any salaries and wages you might be paying to your, family members, staging expenses, yada, yada, yada. A lot of the things, this basically has, I would say 90% of the expenses that you would technically as a realtor would need to know when you're filing your taxes. Now let's come to today's question. Today's question was, I open a PREC, I'm operating a business under it, I'm earning real estate commission. Should I buy real estate under my PREC? Is it advisable? Is it not advisable? What are some of the repercussions? So let's get into the topic today. Generally, a PREC can carry on business related to only real estate. You cannot have any other source of income rather than real estate commission coming into the PREC. That's basically the general rule that RICO has on their website. But what happens to the excess funds that you earn in the PREC? After paying taxes, after paying expenses, you might be accumulating significant amount of money in the PREC and you want to use it towards real estate. What happens then? Technically, Ontario does not have any restrictions on real estate holdings. You can buy real estate, you can hold it under PREC, but the question is it advisable or is it not? So let's get in depth. Always my concern is PREC should not be owning any real estate. Simply the reason being, PREC is technically your active business. In an active business, for example, I'm an accountant, my active business income is earning fees from accounting services. If I start buying real estate under my accounting business and someone was to sue me for something, for odd reason, someone didn't like the services or whatnot, and they were to sue me for my accounting business, anything that is listed under my balance sheet on my accounting business will be up for litigation. That is one of the major reasons why I don't advise buying anything in your operating company. My operating company is accounting business. Your operating business must be the real estate business. So why don't we protect our assets and not buy anything under the PREC? So that's reason number one why I wouldn't recommend holding real estate under your PREC, because creditors or disgruntled clients might go after those assets in a case where if you are up for litigation, if they sue you. By mixing your real estate with your business, you're potentially exposing yourself to risk that towards your assets, right? They can basically take those away. So that's reason number one why I wouldn't want to mix my personal assets and buy it under the PREC. Keep it separate. Reason number two, let's assume you have spent years worth of marketing and have you built up a business. Now it's time to sell the business. When you're selling the business, you can avoid paying taxes on the first $892,000. This limit might have increased now. On the first $892,000 of capital gains is exempt. So my business, if I were to sell it today for $1 million, out of the million, 892,000 can come to me tax-free if I were to sell the business and call it a day. The only precondition to not being able to basically save these taxes is all of my active business was used to earn business income. I cannot have rental income coming into my accounting business. I cannot have, interest income coming into my business, because that will jeopardize the conditions that will allow me to basically skip paying taxes on 892. CRA says if you are selling your business, you can avoid paying taxes on 892,000 provided your active business was that you didn't have any passive income. By holding real estate under your PREC, you are technically earning passive income, which will jeopardize your PREC's eligibility to not skip paying taxes on $892,000. So I would highly recommend, keep your portfolio of, properties that you want to own outside of PREC under a holding corporation. This is reason number two. Reason number three. Reason number C is negative impact on small business deduction. In the beginning, I mentioned the taxes on PREC is actually 12.2% on first $500,000 of income. What do I mean by taxes on only 12.2% on first $500,000 of income? It is called small business deduction. Small business deduction basically allows you that, okay, you know what? If you have a small business, you can pay lower taxes on the first $500,000 of income. But as soon as you start using the money from the business to earn investments, to earn rental income, to earn, capital gains from passive, like from things that are not operating business. So for an accountant, it would be owning a real estate, earning rental income. That's considered passive income. When I start earning passive income in the corporation, I am technically saying that I'm earning income from various other sources. That means your small business deduction, which was 12.2% on first $500,000, this will get negatively impacted. Basically, for every dollar of passive income that I earn, the small business deduction goes down by $5. So if I earn $50,000 of passive income, the entire criteria of paying 12.2% taxes on first $500,000 of income gets wiped out. This is the reason number 3 why you wouldn't want to earn passive income or real estate rental income or any sort of income other than real estate in your operating company. So this is why I would recommend. The whole point of opening a corporation was pay lower taxes, pay 12.2%. Once you start earning rental income, your small business deduction goes down, which creates a problem at the time of taxes, because as soon as you earn passive income in the business, they say that you're not eligible for getting the 12.2% rate. Your rate will be 26% taxes after $50,000 of passive income earned. So something to think about. Now that because a lot of people are concerned about what is the second way of owning it, we cannot own it under PREC. Let's go into the holding corporation path. So I told you not to own real estate under PREC. What is the option? Our option is to own it under a holding corporation. By setting up a holding corporation, what you can technically do is you can technically have the asset protection. You can set it up in a way that your small business deduction does not get jeopardized. And number 3 is related to whenever you're selling the business, it won't impact your PREC's eligibility for capital gains exemption. So all 3 reasons why you shouldn't be owning a PREC, you shouldn't be owning property under a PREC gets addressed once you own it under a holding corporation, because holding corporation is an individual entity where you can basically have all of these additional investments that are not related to your active business. Now you must be wondering, how do I move money from my PREC, because all of the money that I've earned is sitting under the PREC. How can I use the money in the PREC and buy properties from the holding corporation, because holding corporation is not earning any income? So how would that work? The best way is pay a tax-free dividend between your holding corporation from your operating corporation, which is your PREC, towards your holding corporation. There is no taxes when you are moving money from your operating company, which is your PREC, to your holding corporation. Once the money is in a holding corporation through a dividend, tax-free dividend, you can basically go ahead and buy properties in the market. So it's a beautiful way to basically own your properties and protect yourself and protect your business without jeopardizing, all the 3 rules that I mentioned before. So how could real estate investment in a rental property be structured with excess cash earned in the PREC? In essence, your PREC operating corporation would flow the profits into the holding corporation on a tax-free basis, basically a tax-free dividend. Holding corporation would eventually invest in other real estate or other investment opportunities that you and your family feels fit. With proper structuring and ownership of the family members, you can basically avoid the grind that small business deduction gets impacted by, right? So where you were basically, for every $1 of passive income, your small business deduction was going down by $5. This can be avoided by the proper structure of holding corporation. Now that we've talked about how holding corporation can be used and PREC's money can be used, I wanted to highlight that what are the penalties that if you were to earn under your PREC, if you were to earn more than $50,000 of income, what are the tax penalties? So let's assume I own the PREC. In my PREC, I started earning rental income. After I started earning rental income, I basically am losing the small business deduction. As soon as I earn $50,000 of passive income in my PREC, small business deduction, technically all of it gets used up. I have 0 tax penalty. But as I make more passive income through interest, through rental income, my small business tax deduction is going to throw me into a penalty. And this is the penalty that it shows. Every single time you go up by 10,000, the penalty keeps on increasing in the multiple of $7,000. So something to think about and beware of whenever you're looking at the path of owning real estate under your PREC. I've talked about the 3 reasons why you shouldn't. I've talked about the penalties. I've talked about holding corporation as to would be the best way to own it. Now I would like to conclude today's presentation. Thank you once again for joining in.